All right. Hello. How's everybody? This is the corporate finance um, FMB 230. Today's class is about capital budgeting. This is actually the third topic of the semester, and it took a very long time to get to this point because we've spent so much time on fundamental analysis, which is actually, there's a good reason for spending so much time on it because it's such an important topic and it's really, really the foundation of corporate finance and financial management. Now, so as we start on the capital budgeting, and since um, I want to make sure that everybody's on the same page, and I'm sharing this screen with you. So what I have in front of me is actually the PowerPoint file. It's actually PowerPoint in PDF format, and I want to make sure that everyone is also looking at the same thing. So basically. Capital budgeting involves planning and justifying large expenditures on long-term projects. And that's the definition. That's a very brief definition of capital budgeting. But let's think about it. In a plain language, what budgeting means, you are planning a budget for expenditure, right? So you can consider that as planning your budget, but then it is also named capital budgeting. That means it's what does that capital mean? The capital items, in other words, physical capital, or real assets, fixed assets, right? In other words, if your business is in manufacturing, and the manufacturers will definitely need capital equipment, right? So capital budgeting is basically a budgeting for expenditure on capital equipment, right? That can be an interpretation of that. Now, so if you're budgeting an expenditure, right, the expenditures would fall into three categories because the expenditures are basically spending on the projects, right? Capital projects. So what are those capital projects? Well, capital projects can be classified into three categories. One is replacement, the other one is expansion, and the other one is new venture. Now, think about it. In the financial statements, and specifically in the balance sheet, as we went over the balance sheet, we discussed a lot about what depreciation means, right? And what does depreciation mean? It literally means depreciation of the value of the capital equipment, right? And of course, that depreciation we are talking about is on artificial schedule. It doesn't really reflect the actual value of the asset. It just reflects the asset value going down according to the depreciation schedule. But it is not coming from fictitious depreciation of the value. Actually, all the capital equipments depreciate in value over time with usage because of wear and tear. Now, so that means the worn and torn part of the capital equipment must be replaced, right? Otherwise, your production capacity would not remain at the same level. I mean, obviously, wearing and tearing of the capital equipment would result in the lower or reduced production capacity, and reduced production capacity would mean, lower output, and lower output would mean a lower sales. Lower sale means also lower market share. You'll be losing market share if your sale goes down, right? It's not only bad for the company's uh, profit, because uh, if the sale goes down, of course, your earnings would go down. Therefore, um, the owners of the company, or the stockholders, or the equity holders, won't be happy about it. Not only because of that, also in terms of marketing, your market share goes down because your sales revenue goes down, right? You're reaching out to a smaller audience, right? So definitely, you would at least replace the part of the capital equipments that are uh, depreciating, right? For at least for that portion that are being depreciated. Now, second type of project is expansion. Expansion literally means expanding the production capacity. I mean, it could be um, by expanding the I mean, you can expand the production capacity by adding more equipment, or building a larger plant, bigger plant. I mean, bigger plant um, comes with bigger production capacity, right? So obviously, it would require capital expenditure, right? In other words, investment into capital equipment. And the third type of project is new venture. New venture means literally venturing out into a new industry or new line of business, right? So obviously, a new venture would be most risky, because this is something uh, literally you're not familiar with, but you need to expand into a new line of business, uh, either because um, your current line of business is has no growth potential. In other words, the market is saturated, and the industry is saturated. So in this and you have in this industry, you have no more room for growth. Then you would look into another line of business, right, or another industry. That's new venture, right? And it would require a lot of um, investment, but again, it comes with a lot of risk, because this is something you're not familiar with. And then, so so capital projects have increasing risk according to whether they are replacements, expansions, or new ventures. I just explained that. Replacement projects would have the lowest risk. You're simply, replenishing the depleted resource, right? Expansion, let's say you are expanding your production capacity by 10%. That means, adding new equipment, new plant by, 10%. But this would be rewarding only if the demand increases by 10%. And you don't know. I mean, you would only do this if the market uh, outlook, or the economic outlook, is very positive. For example, on average, if the economic outlook is that the economy is going to grow by 10% on average in the next, like, 5 years, or at least for the next couple of years, right? then it definitely makes sense to increase your production capacity by 10%, because on average, if the economy grows by 10%, you can, roughly uh, estimate that uh, the consumption or the spending would also increase by, on average, about 10% on anything, right? Um, and that's why expansion would come with some risk, and new ventures would come with a lot of risk. And then some projects are standalone and some projects are mutually exclusive, right? Standalone project has no competing alternatives, but mutually exclusive projects involve selecting one project from among two or more competing alternatives. In other words, yeah, this is the reason why we are doing the capital budgeting. For example, you have like 10 potentially lucrative and promising projects. And the total of these 10 projects would require the investment of $100 million. Now, of course, each of these projects uh, doesn't necessarily cost all the same. Some projects are, require $20 million investment. Some projects may be, just $5 million, or some even, $50 million. But the point is, if we have, let's say, if the company has only about, $50 million to fund these projects, right? Obviously, some projects will have to be eliminated, right? Then the question is, how do we select the winners and the losers, right? How do we stack them up and prioritize? And of course, within $50 million, those who make the cut will be selected, and within those the constraints of $15, and the others will be eliminated, right? The others will be dropped. So here's an example. How do we evaluate a project? In other words, project evaluation is a crucial key, and it involves, of course, discounted cash flow model. Why? We will need to um, generate a forecast of future cash flow. For example, C0 represents cash flow at time one. That means, at time zero, right? Cash flow at time zero. Time zero is now, or the initial, the year, the original starting year, and of course, at time zero, you need to make an investment. An investment of 50,000 is, in this example, that's initial investment or initial outlay, which is a cash outflow, right? That's why it is negative, because if you are building a plant, right, or purchasing an equipment, and which costs $50,000, so that's a cost, right? Cash outflow. That's why it's negative. And even in year one, I mean, this new project or this project doesn't necessarily generate any income until year two, right? So until the end of year two, and until the end of year one, it just requires additional cash outlay or uh, expenditure or investment, right? So that's why it's negative. From year two, you are finally generating positive cash flow, right? So 15,000, over the next 4 years. At the end of year 2, at the end of year 3, at the end of year 4, and at the end of year 5. So then, how do we evaluate such a project? And since you have all done Finance 100, it's a very simple concept, right? Uh, you would need to discount all these future cash flows back to time zero, right? Because time zero is present. Now, so these are all future values, right? C1 through C5, that's all future values. C0 is the only um, present value, right? So then you get the idea, right? All of the uh, positive future cash flows must be greater than uh, the present value of all cash outflows, right? In other words, the present value of all positive future cash flows must be greater than the present value of cash outflows, right? And that's a very straightforward idea, right? It's a very straightforward logic. Now, then the question is, how do we find the present value of those future cash flows? Well, we know the discounting formula, right? But what's important in the discounting formula is the discount rate, right? Because depending on the discount rate, a lot can change, right? If the discount rate is too high, the present value will be too low. If the discount rate is too low, the present value will be too high. But anyway, the cost of capital, so discount rate is also called cost of capital because this concept is something we covered in Finance 100. Literally, cost of capital means literally that's the cost the cost you pay, right, to borrow the capital or to raise the capital. So, move on. It says, here, the average rate a firm pays investors for use of its long-term capital. Firm raises money from two sources, debt and equity. A project is a good investment if it is expected to generate a return that is greater than the rate that must be paid to finance it. So what does this mean? If the rate of return from the project is greater than the cost of capital, right? Then obviously that's a good project, right? Because the return your return is greater than the interest or the discount rate, interest rate that you pay. Now, again, we will need to come back to this concept of cost of capital because what it means is actually weighted average cost of capital. Okay. Now, we're going to come back to the concept of weighted average cost of capital later. But here are, a few capital budgeting techniques. Okay. One is payback ratio or payback period. And payback period is more appropriate in this case. It just refers to how many years to recover initial cost, right? So this concept is completely devoid of the present value, right? Because if the initial investment was, in our example, 50,000, right? And then 10,000, right? Actually, we need to discount the C1 to the present value, but in payback period method, you simply, consider there's no discounting. You just, uh, uh, put them on all equal playing field, even without discounting. So the idea is, your investment is 60,000, and um, sum of all these future cash flows, that's 4 times that. That would be then 60K. So then you break even after year 5, isn't that right? According to this, you simply break even without any discounting. You just, compare them in face value, and then at the end of year 5, right? You break even. So payback period is then, after 5 years, right? Or yeah, this is end of your series. Time zero is now end of your. This is, so end of the first year, end of the second year, end of the third year, right? So after year 5, they break even, meaning they recover the initial cost. Now, this is once again, uh, if you are investing, you would want to make a positive return, not just break even, right? But the idea is that in this case, if you keep your investment in this company for more than 5 years, then you will get a positive return after year 5. That's what it is. So the shorter the payback period, the better it is. Next is net present value, and this is quite a straightforward concept. The present value of cash inflows minus the present value of cash outflows. Okay, so then if the present value of cash inflows are greater than the present value of cash outflows, then the result is positive, and thus positive net present value. And of course, you pick the project that has positive net present value, right? If it doesn't have any, if it has zero net present value or negative net present value, of course you avoid, right, such a project, right? You drop those projects. And then among the competing projects, right, then the one you can prioritize, you can stack them up and, put them in order, right? There's number 1, number 2, number 3, number 4, right? And according to which one has the highest net present value. And then there's internal rate of return. Now, internal rate of return is mathematically, it's the if you discount all future cash flows, right? The bottom line is, if you discount all future cash flows, then at least it must be equal to the initial investment, right? Think about it. And then what kind of, as I said, depending on the discount rate, depending on what you use as discount rate, the present value of all future cash flows can be greater or equal to or less than initial investment. So I think I should use the whiteboard, because the way it is, I cannot write on the this PowerPoint. So let me switch, okay? Stop sharing the PowerPoint and let me switch to Okay. Let me switch to a whiteboard. Alrighty, so I hope everyone can see. Now, so let me get back to the concept of net present value, right? So, what is net present value? Net present value is literally what you're doing is you sum present values of all future cash flows, right? And cash flow at time n, where n runs from 0 to, let's say, time t. Okay? So what does that mean? If cash flow is, if n is 0, that means cash flow at time 0, which is already negative. It's already present value because it's at time 0. But it is negative because at time 0, it's the initial investment, right? Now, so net present value, you want this to be positive, right? But it can be equal to 0, or it can be even negative. But when it is positive, that's the one you pick. If I write it, it's going to look like this. So CF 0 plus CF 1 plus CF2 plus, right, and ellipsis, right? I cannot put that there, so I'll just do this. And then plus CF cash flow T T minus 2. I'm sorry, I forgot to put present value. Okay, so but then think about it. Present value is like you're discounting it by 1 plus R, and you're discounting it by 1 plus R squared, and so on, right? And this will be 1 plus R T minus 2, and then plus cash flow at time T minus 1, and then 1 discounted by 1 plus R raised to T minus 1. This is very difficult to write with a mouse, right? And then finally, CF cash flow at time T, and then discounted by 1 plus R raised to T, right? You get that, right? And think about it. This term is already negative, right? So the point is, if some of all of these positive future cash flows are greater than the initial cash outflow, the negative, then if that's greater, then it will result in positive, right? Net present value. Okay, so that explains net present value. I just wish I could draw it better, but using the mouse, it's really, really difficult. Okay, now, and let me, again, what is internal rate of return then? Okay, now let's think about it. From that net present value formula, right? If you think about it, this CF0, right? Initial cash flow, which is initial investment, which is negative number, right? And then the rest of them are basically cash flow at time n, right? And running from then, in this case, 1, because cash flow at time 0 is here, right? Until until time t. Now, and suppose this is 0, right? Suppose net present value is 0. What does that mean? Then you can move CF0 to the left-hand side, right? Because it is 0. And if it goes to the left-hand side, it changes its algebraic sign, meaning it was negative here, but when you put it here, it is positive because it is transposed. So here, on the right-hand side, all the cash flows are basically present values, right? And you have 1 plus r raised to n, right? I'm not going to write this anymore because it's already there. Now, here's one question. Now, under what condition, right? I mean, this could have, depending on under what condition, right, will the left-hand side be equal to the right-hand side? In other words, the right-hand side could have been greater than the left-hand side, or the left-hand side could have been greater than the right-hand side. There are 3 possibilities, right? But ignore these possibilities, but just focus on the equal, right? That then means, the project breaks even, right? Makes sense? If the present value of all the future positive cash flows are equal to the initial investment, that means the project has simply broken even, right? But then what makes that happen? Well, if all the other variables are already known, right? For example, all these future cash flows are known, right? And initial investment is already known because you would have to know how much you need to invest in this project, right? Without that, you cannot even start budgeting. Now, so think about it. These n's are known because it's projection of cash flows in year 1, year 2, year 3, year 4, year 5, all the way to year t, right? Time t. So then, what is the only unknown? The only unknown is this the discount rate. And now think about it. Depending on this discount rate, it could be either the right-hand side being greater than the left-hand side, or the left-hand side being greater than the right-hand side, and the left-hand side being equal to the right-hand side, right? It is all determined by what this discount rate is, right? So that means there is only one single unique, right, number that would equate the right-hand side to the left-hand side, right? You understand? There cannot be multiple values. There is only one value of R, and only at that can make, the left-hand side equal to the right-hand side, right? So that unique number, then that unique discount rate is called internal rate of return. Okay. So this is the mathematical concept of internal rate of return. The discount rate that makes the right-hand side, which is the projected future cash flows, positive, right, equal to the left-hand side, which is the initial investment, right? So that's more like a break-even condition, right? And so that is, internal rate of return. And the next one, let me switch back to that PowerPoint. So let me, that will be a brief pause, and then, okay, let's go to, all righty, there you are. Okay, the last capital budgeting technique is profitability index. So that's the ratio of present value of inflows to outflows. Now think about it. Profitability index is an improved version of payback period, right? Why? Now, in payback period, you are simply, comparing, taking the ratio of cash inflows to cash outflows, right? So, which is, a very crude method, because you don't incorporate any such concept as present value, right? But here, to take the profitability index, right, you are taking the ratio of present value of all future cash inflows to the present value of all cash outflows, right? Of course, cash outflow is not only at time 0, as in our example, previous example. You can still have to pay out or invest in year 1 as well. And in that case, that cash outflow needs to also be discounted back to present, right? So I already explained these concepts. Shorter paybacks are better, and if using net present value method, right, standalone projects, first of all, it doesn't have any competing projects, so it's judged, on its own by itself, right? So either, if the payback period is shorter than the policy maximum, you accept it. If the payback period is longer, then you reject. Um, in a mutually exclusive projects, right, you go for the shorter payback projects, right? But again, I already discussed the weakness because it's very crude method, right? Uh, then let's take a look at this is numerical example of payback period. And I don't think we really need to uh, go over this because this is very crude, simple method, right? Also, um, the case of mutually exclusive projects, A and B, right? And payback period, right? Whichever has the shorter payback period, right? Although it's crude, it's quick and easy to apply. Even a lay person can apply this, and it just serves as a rough screening device. You don't use this for more, real serious um, capital budgeting uh, purpose, but just as a rough rule of the thumb, right? Now they improved. Um, Actually, the improved version is the present value payback method. Well, then you calculate the payback period using the present value of project cash flows, right? But again, if you were able to do this, then you would rather use net present value method or internal rate of return or uh, profitability ratio, right? Next is net present value, and I've already, discussed the concept, so it won't be that difficult, right? So basically, C0 is already, present value, so you don't have to discount it. But even if you discount it, that means, this is C0 over 1 plus K raised to 0. And anything raised to 0 is just 1. So it's just, C0, back to C0 anyway. And this is negative because it's cash outflow. And then all the rest, it is assumed they are all cash inflows and they are discounted. Now you see the symbol K. What does that stand for? That stands for cost of capital. Okay, so now you understand cost of capital is another name to call the discount rate. Okay. So the point is that if the present value of all cash inflows are greater than present value of cash outflows, then positive net present value, and that's what you pick, right? And if it is a standalone project, right? Uh, as long as it has a positive net present value, yeah, uh, accept the project. But if you have competing projects, and of course, the greater the net present value, right? That's the number one. It's preferred, right? Now, a project's net present value is the net effect that is expected to have on the firm's value. Of course, net present value is basically what? Your positive, uh, it's like net profit, right? But it's not just net profit, it's slightly different from net profit, it's net cash flow, positive net cash flow. And you understand the difference between, net profit and positive net cash flow, right? We discussed it at length in the previous topic, right? And the goal of any business is no matter what they say, right, in the front, it all boils down to maximize the shareholders' wealth, right? Of course, that's not ideal, right? The ideal goal of business is to maximize the stakeholder wealth, stakeholder value. Stakeholder doesn't necessarily include only the shareholders, right? It includes also debt holders. It includes also the employees. It also includes the community around it. But that is just ideal. I mean, think about it. Who owns the company? The equity holders or the shareholders, right? The stockholders. And who holds the uh, who holds the right to fire the management or hire the management? The board of directors will represent the shareholders, right? So then, no matter what they say, CEO cannot pursue stakeholder value when stakeholder value is not necessarily coinciding with the shareholder value, right? Makes sense? Because if the CEO pursues only stakeholder value, which is against the shareholder value, then he can't keep his job. He'll get fired very soon, right? So that's something you have to consider. Now, so we already know the decision rule of the net present value method, right? Standalone project, we talked about that. Mutually, if it is mutually exclusive, whichever has a greater net present value is preferred. Now, so here we have an example of net present value, but before we go on to internal rate of return, I guess we can talk about internal rate of return as well, but we already know. So let's go straight to the example. Okay, we'll go straight to the example of net present value. Okay. So I want you to let me switch to Excel. So let me stop sharing and go back and to and share application screen and application window. Okay, here's the Excel file. So, all right, now do you all see this file? This file is posted in your lecture notes folder, course material folder, right? Lecture notes folder. I will make a copy. I have made a copy also available in the temporary folder, and the file name is Corporate Finance Topics. Okay, Corporate Finance Topics. And then once when you open it, you will see multiple bottom tabs, and you have to come to the first bottom tab. Okay, so here let's take a look at the first example. First example is what? Okay. I have entered already the data here, and every dollar value here is basically in thousands. So that's like, it's not $60, 60,000, right? So column B is actually cash flow at time. So let me put it this way. Let me just simply put another row there, insert. Okay, then I'll change that to 0. And this is time, right? This is cash flow. Time t, right? Oops, not there. I put. Okay, I'll. So let me center it and underscore, right? So it's quite obvious, what we're trying to do. So at time 0, right, there's cash outflow of 850,000, right? Initial investment. And from the end of year 1, we generate positive cash flow from the project. So then what we need to put there is the present value. Of course, present value, and we need cost of capital to calculate that. You might think, oh, this is already in present value, so why would you need to calculate that again? I don't need to calculate that again, but I'm just doing that anyway to give it structural consistency and uniformity, right? So this is, because this discount rate will be used over and over, what you will need to do is you need to lock, right? You know how to lock. If you hit F4, it's going to lock into that cell, right? So it's going to lock that B1, right? So it's not going to change when I copy and paste it. So then you raise it to 0. We know if you raise it to 0, it's going to be just 1, so it's going to be self. But the benefit of that is once you do that, then I can drag it down. And as I drag it down, what do? They are all automatically, discounting all these future cash flows into present values. And then at the bottom, right, I have already built in the auto sum there, right? So by having auto sum there, it's going to sum everything above it. Now this means what? This is the net present value, and that's the net present value of positive net present value, $150,000. So what do you say? Accept or reject this project? Of course you accept this project, right? Because it's got a positive net present value. Okay. So that brings us to the end of this session, because we're supposed to, it's 1 hour, it's been 1 hour, 15 minutes, I believe. So we're going to continue in the next class with, we're going to pick up from where we left off. So it's going to be the Excel exercise about internal rate of return, IRR. Okay. All righty. So that wraps up everything. That wraps up our lecture today. Thank you for watching. I'll see you guys next time. End of video.